Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for watching on YouTube, and thank you for listening on the podcast. Greatly appreciate it. This channel is dedicated to rational investing. We buy free cash flow and we pay a reasonable price for that cash flow in the hopes of beating the stock market over the next decade. Nobody knows what the future holds, but we try to be conservative with our assumptions, and hopefully that gives us a little protection to beat the stock market. Now, NVIDIA is down 40% from its peak, and this channel has been very critical of the high premium and strong growth numbers required to make NVIDIA pan out. We have been cautious and warned investors not to put money in this stock, and we've been rewarded. We nailed it. The stock is down 40%. Growth forecasts have been adjusted. Let's take a look at this stock now and figure out how much cash money does it make, and is it well priced? And if we buy it today and held it for a decade, could we beat the market? Ready? Let's get to work. Okay, what we're going to do is we're going to do a couple things with NVIDIA. One, we want to review their latest quarterly results and figure out where the decline in revenue has happened, and if we think it's going to revert back to its normal trajectory or it's going to be a permanently reduced sales volume. Number two, I want to look historically to figure out what have they been doing in the past 2019, what were they telling investors, what was the growth rate of industries, and number three, we want to build a conservative forecast for this stock and understand what the price multiple is for the stock and if it's expensive or not. All right, the first thing we're going to do is we're going to review the 5 key attributes that we use in this channel to evaluate all stocks. That's not a be-all and end-all list. There's lots of things you need to consider before making an investment. Consult your investment advisor. This channel is not investment advice, merely entertainment, my kind of vlog of how I, as a CFO and value investor, approach looking at companies. But we're going to review these 5 key factors as a launching point for where you want to start digging into stocks. Number one, top-line revenue growth. We want to see 10 years of top-line revenue growth. Number two, strong earnings. We want to see earnings growth for the last decade. Number three, strong free cash flow. We want cash flow to be strong. That's the name of the game. Number four, low debt. We're not buying stocks that are over leveraged. You better have 3 times debt to EBITDA or less to be considered. And number five, the most important, you want a well-priced stock. I once worked for a private equity company with the managing director came out. There was a sea of analysts out there. He and I were chatting. He said, Cameron, I can have all kinds of analysts build all kinds of forecasts for me, and ultimately forecasts are mostly wrong. What the best thing I could have is a stock that trades cheaply, because if I can buy a stock cheap enough, I can most likely make money on it. No matter what forecast you put in front of me, you're most likely going to be wrong, kind of a 50-50 bet. So the name of the game is never pay too much for stock. That's why number 5, being well priced, is probably the most critical, and it's a very difficult one to hit even on this channel. We rarely find companies that meet all 5. We are more recently in this down market finding those companies. If you rewind in our channel 2 years ago, a lot of stocks were fully valued. I was showing you that in our IRRs. I was getting a lot of single-digit names, single-digit IRR numbers. It was very, very difficult to find a stock that could beat the market without a huge growth curve assumption, and that is an indication of an overpriced stock market. Now, there are lots of stocks with a 1, 2, 3, 4% annual growth is expected to beat the stock market. Check out my website, cashflowinvestingpro.com, for more of that. Join the Cash Flow Club for those stock tips. But let's take a look at NVIDIA. We're going to evaluate on the 5 key factors, and we're going to look at 9 years of historical financials and figure out how much cash money this stock makes. Ready? All right, here we go. All right, the first thing we're going to do is we're going to pull up their Q3 2023 financial statements. Their fiscal year ends in January, so we're filming this in Jan now. In another month or 2, we'll get their full year results, but we can approximate what it's going to be by taking a look at these numbers here. They're giving you quarterly financial results. This is revenue by quarter for the company. So 7.1 billion, 7.6 billion, 8.2 billion, and then it declines 6.7 billion to $5.9 billion of top-line revenue. And if we dive into the detail here, we can figure out what's going on. Data center is a big piece of their revenue, about 40% of total revenue, has been growing from $3 billion in one quarter to 3.2, and then it kind of plateaus, 3.8, 3.8, 3.8. So that business is kind of stabilizing, I think, as businesses overall tighten their budgets. because of the economic slowdown. If we go to gaming, this is where you're going to see the huge earnings hit or the huge revenue hit for the business. Gaming was $3.2 billion. So basically, even with data center, you had data center and you had gaming being even on a quarterly revenue basis for this company. Both of them at about 40% or so of revenue. Gaming goes from 3.2, 3.4, 3.6 down to $2 billion. That's more than 50% haircut in one quarter. Down again by 50% to $1.5 billion. So in 6 months, their quarterly revenue went from $3.6 billion to $1.5 billion on a quarterly basis. And what that's done is if you take this and annualize and say, hey, we're going to stay at these levels going forward, that lowers materially the size of the gaming business for NVIDIA as a whole. It goes from roughly 40% of revenue in line with data centers down to about 14 or 20% of revenue, which is much, much lower, and it really impacts their ability to grow. And if you read some of the comments here in the quarter, the decline reflects lower sell-in to partners to help align channel inventory levels with current demand expectations. That's fancy language for basically people aren't buying it, we're cutting back. That's essentially what they're saying. And I think what's going on is the cryptocurrency pull down is limiting the demand for laptops and CPUs that they need, that this cutting edge technology was really selling into that demand. And as consumers were making a lot of money, as money was cheap, people were upgrading infrastructure. But now that money's tightened, crypto's down, people are kind of hunkering home a bit more. You don't need the latest and greatest, the absolute cream of the crop processor or video cards. You can kind of scale back, and that's what I think people are doing. The next level is the vision systems. Vision systems was basically 600 million, not billions, by the way. So the other two were much, much bigger. We were talking $3.8 billion in a quarter and $3.6 billion a quarter. Now the vision system is 600 million, much, much smaller, drops to 200 million. And the automotive section, which is growing, but it's only $250 million. That's not that much in the grand scheme of things for this business. So that overall shows you the business for NVIDIA. Their outlook was saying for the next quarter, they're roughly $6 billion of top line revenue for the quarter ending Q4 outlook. They'll probably get very close to this. And you're going to see margins for this business Q4 come down as they had still a lot of sales staff, still a lot of overhead, but revenues come down. We would expect margins, EBITDA margins, to tighten up in Q4 as the CFO starts cutting people, cutting back to get margins back up on this new normal, which is lower revenue. All right, before we move to review the financials in a historical basis, I wanted to pull out one slide from an old release from NVIDIA. This is the 2019 Investor Day presentation. Back in 2019, they were talking about the gaming revenue as being a huge growth driver for the business. And they were right. The last many years from 2019 to 2021, it was a major, major driver for the business. Even historically, this goes back to 2013 when they kind of just getting going with about $1 billion in annual revenue for this industry in gaming. That billion in 2013 grew to $4 billion, this is annual numbers, in 2014. It grew to $6 billion in 2015, $8 billion, $10 billion, and $12 billion in 2018. That would continue to grow, and they were correct about that business. The interesting thing now is people are tightening back. What is the normal level of demand for their type of processor? What does that look like? I think that's a huge guess, and nobody really understands where that number is going to be. We're going to take a wild guess at it. I'll show you how we do that here in a second and figure out where we think this business can go. But ultimately, it's going to come down to how much, what multiple are we paying for this earnings? And you want to try to protect yourself by not paying too much. We're seeing that over and over and over again in this market where people had very, very high growth expectations. Tesla is one of those stocks where just because you're growing, but maybe growing slower than the market would like, the stock is going down because people are unwilling to pay 60 times earnings for a stock that's growing, say 5, 10, 15%, and not 20, 30, 40, 50% like they expected in the market. Hey, sorry to interrupt. If you like the content, please subscribe. I greatly appreciate it. Also, if you want more stock tips, check my website out, cashflowinvestingpro.com, where I produce one-pagers like this one summarizing 10 years of financial information for American Express. I give you a forecast of what I think it's going to do, and currently, I think it's yield 23% IRR for the next decade. An amazing stock pick. There's lots more. Check out the link below for a free one-pager at cashflowinvestingpro.com. Okay, let's review the 9 years of historical financial information for NVIDIA. These numbers are as of January 31 for their fiscal year, and I'm pulling them directly from their 10Ks, the annual reports, which you, as an investor of an equity security, should be reading for every single company you own every single year. It doesn't take you very long. There's a lot of disclosure and a lot of repetitive information in that, but you must read the 10K for every stock that you own. That's going to limit the number of stocks that you can buy because you just physically can't get through and process all that material. And then two, it's going to, by limiting the number of stocks you can buy, it's going to focus you into the ones you're most confident about and hopefully a little bit more conservative to protect your money. Let's go through and take a look at NVIDIA's revenue here. So 2014, year-end January 31, $4.1 billion, and that's gone up to 4.6 in 2015, 5, 6.9, 7, 9.7, 11.7 in 2019, $11.7 billion. It dipped for the COVID to 10.9, almost 11. Back up in 2021 at $16.7 billion, and a new high last year, 26.9. Almost $27 billion of revenue in 2022. That is an annual growth rate, annualized average growth rate over that period of time of 26% top-line revenue growth every single year during the last 9 years. Fantastic. That's what we want to see. That checks our box. We want to see a business that is able to grow revenue. Perfect. Now let's go through earnings. EBITDA, earnings before interest, tax, depreciation, and amortization. It is a proxy for a normalized, I'll put that in air quotes, normalized operating income for the core business itself. Some of the large companies we deal with have a number of issues that we want to exclude from the earnings. Berkshire Hathaway is a very good example. Berkshire Hathaway owns a lot of equities in its business, and the change in equity price year to year flows through to their income statement. You want to remove that because that is mudding up the waters of what the underlying business is doing. As the stock market oscillates up and down, that change is pushed into the income statement and affects their earnings. EBITDA removes that, and we want to figure out what does the core business generate on an annual basis. So 2014, NVIDIA made $735 million on $4.1 billion of revenue. And their EBITDA has grown from $735 million to $979 million to $1 billion, 2.1, 3.4. 4, it dipped for COVID, went down from 4 billion to 3.2, but back up to 5.8 and 11.2 all-time high EBITDA for this business. Number one, it's positive every single year. Number two, it's growing every single year. Fantastic. That's a 41% annualized growth rate over this period of time. Definitely checks the box for us that EBITDA is growing. It's positive. I love the fact that it's positive every single year. Great consistency. You will also note here that the growth rate of EBITDA is above that of revenue. 26% for revenue, 41% annualized growth rate for EBITDA. What does this mean? That means margins are expanding. And if I do the little math exercise for you, and we take a look at the EBITDA margin for the business over time, it's gone from 18% up to a high of 42% EBITDA last fiscal year. That is an astounding change. Let's just take a minute to appreciate how big of change this truly is. That has moved 24 points. That's 2,400 basis points. That's an amazing move. And I think actually a little unsustainable. If I were to think of a business like this that is doing the manufacturing to have a margin of 42%, having come up from 18, I think that is a bit euphoric. It's too high, and I would expect that to come down in time as labor pressures, wage pressures, pressure earnings, supply chain issues like they continue to experience. That should come down, and that's something that we're going to adjust. We're going to adjust margins back down to a more conservative level as we go forward. But I digress. Revenue and EBITDA, check the box. Let's take a look at enterprise value. Now, what is enterprise value? This is probably the biggest single issue new investors need to wrap their mind around. What trades in the stock market is not the value of the business. No. What trades in the stock market is only the equity portion of the value of a business. What do I mean? Let's think of your house. If you buy a house, let's say you bought a house for $1 million. You go to the bank because you don't have $1 million cash. You say, hey, I want a mortgage. The bank's like, okay, I'll lend you $800,000. You put down $200,000, you buy a house. The enterprise value is $1 million, which is the house's worth. But what you actually put down on the cash, $200,000, that's your equity. And that's what trades in the stock market. So as the market price goes up and down, it's only the $200,000. It is not the $1 million at the value of the actual house. That's the big difference between the stock market and, say, the real estate market, where they generally display the enterprise value of the house. They only display the equity value of the stock market. And so you, as an investor who judge stocks cheaply or expensive based on the dollar value of the per share, are completely ignoring how much debt and leverage a business has on it. McDonald's is a great example of an over-leveraged company that continuously borrows money to pay back stock, boosting their earnings per share, while earnings themselves is flat. Coca-Cola, by the way, is doing the same thing. They just don't have the leverage. All right, so what we need to do here is we want to calculate what the enterprise value of the business is. And the way we do that is we take equity, the stock market, plus debt, minus excess cash. So let's start with debt. Debt, short-term, long-term liabilities. You want bank debt, you want senior secured, junior, but bank debt. And you want capitalized leases. If the business has a pension, you want the pension plan or the pension liability. $1.4 billion of short-term and long-term debt in 2014 when we start this exercise. That has grown to $11.6 billion last year in 2022. Really only spiked during COVID. So they had $2 billion of debt, almost flat to the 1.4 they had in 2014. But leading into COVID, they went into COVID with $2 billion of debt. Coming out of COVID now this last year, they have $11.6 billion. So they've borrowed almost $10 billion or $9 billion of debt during that period of time. Well, what has happened to earnings? Earnings has also gone up tremendously. They had $3 billion of earnings going into COVID. Coming out of COVID, they have $11 billion of earnings. So they have lots of earnings to cover the debt. So that seems reasonable to me, but we'll check it in a bit. The next thing I want to see is cash, excess cash. Now, what do I mean by excess cash? This is the next thing that confuses a lot of people. This is not total cash on the balance sheet, because all businesses need a bit of cash to continue to run. As an example, the best example is payroll. Employees work every single day. And every day they are earned a salary or an hourly wage, a paycheck. But you don't pay them every single day. You pay them every 2 weeks, generally. Well, so during that period of time, when you're taking in revenue, because you get revenue every day in some businesses, but you don't pay your employees every day, you pay them every 2 weeks, that's revenue coming in the door that you haven't paid out in labor that derive the revenue. So you need some cash to cover that. That's your float. That's your working capital. So you can't take all the cash out of the business. I like to use the market securities line on the balance sheet. I figure if a business is carving out cash to such a degree where it's putting it as its own line below cash line on the balance sheet, I'll pull that as excess cash, meaning it's cash that could be dividended out before you sell the business, and it's not included in the enterprise value. And what I like to see here is going into the pandemic, they had $10 billion of excess cash. Coming out of the pandemic now, they have $19 billion. So $9 billion of increased excess cash, along with a $9 billion lift in debt, to me, is wonderful. That means they borrowed money as a prudent company to ensure that you don't know what's going to happen in the pandemic, so you borrow money to give yourself enough staying power to weather the storm. And because that money is still here, the $9 billion, that means they didn't spend a dime of it. So their operations were able to withstand the shock of the pandemic, still generate cash flow to pay their employees, pay their debts, do all the things, and they did not have to touch the reserve that they sucked up at the start of the pandemic. I like to see that. That's a good little check that the business is generating cash flow if they're able to borrow the money and it's still on the balance sheet. Okay. Market cap. Market cap is shares outstanding times average price for the fiscal year. I use January because that's their Jan fiscal year end. And I get $9.3 billion of market cap. Has absolutely ballooned to $620 billion of market cap last fiscal year. If you rode that rock, congratulations. That's an absolute home run. $620 billion of enterprise value in a company that generates $11 billion of earnings is a very high price. How high of price indeed? Well, it's 54 times enterprise value to EBITDA. This little metric here for us is the well-priced. There's one gauge that we use to figure out well-priced. What does it mean? It basically says here's the entire value of the business. EBITDA is how much earnings on an annual basis the company generates. And by dividing the two, you're simply saying how many years of the current earnings level do I need to have before the business generates enough money to buy itself? That's it. And so what this is saying is, like back in the day, in 2014, this business only needed 10 years of earnings to pay for itself. A very, very cheap company. In fact, earnings didn't stay at $730 million. It grew really quickly. And this growth meant that you really paid a whole lot less for that business. I mean, great buy. But as the story grew and more investors piled in, it drove demand up, and that demand drove the premium people are willing to pay for that stock from what was at that time 10 years of earnings on a multiple basis to 55 years of earnings. I mean, at some points, like, how long do you want to wait to get your money back? What this is saying is it's saying that you're expecting the business to grow tremendously in order to make this earnings relative to your lifetime. And that's where we get into the art versus the science of investing. It's how much to pay for a company with reasonable growth expectations. And we're going to get into this in a second. It's one of the things I was critical. If you check the last video that we did where we nailed the reduction coming in the price, we were calling out these multiples and we're saying that the growth premium that they're tied to is simply too high. The next thing I want to cover is just the net debt, because they have more excess cash than they have debt. You net these two and they're unlevered. They have zero net debt on the business, which is great. That's one of the boxes that we want to check is low debt. Low debt is checked because it's zero. Let's take a look at free cash flow. Okay, free cash flow, I've adjusted here the cash flow from operations. What is cash flow from operations? It's the pure cash money that they make from operations. It takes net income, which is the income statement, and we all know the income statement has non-cash charges in it all throughout the place, and it converts that net income into cash money from running the business for the 12 months ending for the fiscal year. And that last year in 2014, they made $835 million of pure cash money on the $735 billion of EBITDA. Now, I've adjusted this for share-based comp. I've subtracted the share-based comp, even though share-based comp is a non-cash item and is added back to the cash flow. So these numbers would be higher because so many companies use employees' stock comp as a way of paying people but not having to report it. I expense it to look at kind of an adjusted number for me that gives me a little bit of cushion. So $835 million of cash, of Jack, that they made in 2014. And that has grown to 906, 1.1 billion, 1.6 billion, 3.5 billion, 3.7 billion, 4.7 billion, 5.8, and 9.1 billion dollars of Jack that they made last year. Fantastic. And it's interesting that this number continued to grow through the pandemic. That's an average annual growth rate of 35%. Good job. Now, what I want to note here is the 35% growth rate, which is a strong growth rate in free cash flow, is very close to the 41%. I'll say very close because it's a broad category, but it's very close to the 41% annualized growth rate of EBITDA that we experienced over this 9-year period of time. And that means the accounting team is doing a good job expensing costs that come in the door. They're not, if you see a company where earnings are growing like crazy, but free cash flow is going down, someone's monkeying with the books. It's very, very hard to keep those two out of line over the long period of time. You might have 1 year here or there, that's fine. But on trend, over time, it's very difficult to have earnings go up and cash flow not follow. And it's a nice check to make sure you're getting the cash money that you're telling people in the income statement you're actually getting. CapEx is fairly low for this business. They have not put a tremendous amount of CapEx back in relative to the free cash flow they make. This ratio of free cash flow to CapEx is nice and low. It's basically 10%. You look at last fiscal year, they made $9.1 billion of free cash flow. They put $976 million back into the business, leaving almost $8.1 billion of jack left over that's piled up for them to do something with. The next thing they need to do is pay debt. Well, they have no debt, relative speaking. So that money, that debt, that free cash flow is able to flow through to you and I, the equity owners. That's why we buy stock. We buy stock for this number, this specific number. So last fiscal year, I'm going to zero out this debt payment here just for a second so we can kind of a true number, putting debt aside. They made $8.1 billion of free cash flow for the enterprise. Now, they had shares of 2.5 billion shares outstanding, and that number has grown from 2.38 billion in 2014. That's an average annual growth rate of 1%. This troubles me. A company that makes so much in earnings, generates so much of free cash flow, has excess cash on the bank, should be buying back stock. There is no reason for them not to be buying back stock. The fact that they're printing stock, to me, means that they're giving away the equity from a wonderful business. They should be buying it back and rewarding the shareholders. I would like to see them do that. But if I take the $8.1 billion of free cash flow that they generated last fiscal year and I divide it by the number of shares outstanding, I get $3.21. That is the per share free cash flow that this business generates. And we will look into the stock market to figure out what that stock price is. We can compare the two and come up with a yield. It's a free cash flow yield. Many people look at a dividend yield and they buy stocks because of the dividend, but they're missing out on the true yield, which is the free cash flow. Remember, dividends are paid from this number. So are share buybacks, so are acquisitions. You want to use this number when you're evaluating stocks. And what that means is you've got a yield here of 1.3%, which is very, very low. Last year, the stock was $245 a share. If I divide the $3.21 of free cash flow by the share price of $244, I get 1.3%. That is very, very low. On this channel, in the podcast, what we're trying to find, and we want businesses that generate a lot of free cash flow relative to the price. I want to see something that's 6, 8, 10, 15% free cash flow. Now that is a business I can get on board with. You show me a stock that's generating 10% free cash flow, is growing revenue, growing EBITDA, has low debt, and has low debt and has strong free cash flow and is yielding 10% free cash. That is a well-priced stock, and I bet you that stock is going to outperform the stock market in 10 years. It just is. It's throwing off so much free cash flow, even with zero growth. You're making 10% on your money. Well, the stock market makes 10% in a year, any given year, during a 10-year period of time, about 10% is the average return. So if the stock that you buy is yielding a free cash flow of 10%, that means with zero growth, you're even with the market. You get any bit of growth in the stock, you're beating the market. That's why free cash flow, to me, is the most important thing you're buying in the stock market. And that's why I do this channel, is I try to educate people who are pulled into the CNBC world, watching the talking head, watching Jim Cramer talk about his nonsense. He has no idea. He's just making it up every day. You want to buy free cash flow. You want to buy high-yielding free cash flow assets, and you want to hold them for 10, 20, 30 years and don't look at them. And just let them continue doing their thing with solid management teams That's the way you get rich. You own a focused portfolio of stocks for a long time, and that compounds over the years where you pay no taxes for because you didn't sell, you didn't roll your portfolio, you're not hopping from here to there, you just let it ride. Most of the back and forth that you see washes away if you start zooming out 5, 10, 20 years. What happens this quarter or next quarter no longer matters. And most of the stock market people are guessing what's going to happen this quarter or next quarter. If you zoom out, suddenly it becomes a little bit easier to figure out what you should be buying. All right, let's take a look at the last quarter. I want to do a couple things, then we're going to forecast this business. Now, before we dive into that, I do want to remind you, I do teach a course. You can check out that course, cashflowinvestingpro.com, where I give you this Excel sheet and I teach you how to do this. All right, the next step we need to do is we need to figure out where are they going to end the fiscal year of 2023 for them ending January 2023. So behind me, I took the data I showed you earlier of the revenue per sector for the company and displayed it behind me. We're going to walk through this and I'll show you the change and how big the change is in the gaming business. And then we have to figure out what do we want to do with it. So here's Q1 2023. They made $8.3 billion of total revenue. Data center was 3.8 of that. Gaming was roughly equal at 3.6 billion, and you've got visual, you've got automotive and other kind of rounding out. But in total, you've got gaming was 45% of revenue. Excuse me, this is data center was 45% of revenue, and you've got gaming at 44%. So those two are 90% of the business. That's really where you can focus in for historical purposes. The other ones have to get much bigger before they're really driving the business. So data center is roughly flat, about $3.8 billion each quarter for a full year of $15 billion. If I look at gaming was 3.6 and it dropped to 2, dropped to 1.5, and I'm going to hold it even to 1.57 for the quarter. That's $8.8 billion of revenue for the year. And that's a 50% reduction in the revenue within 1 year. Q1, it was 3.6 billion. Q4, we're saying 1.6 billion. That's halving in value. And what does that look like on a run rate basis? What do I mean by run rate? A run rate basis is just taking a particular quarter and multiplying it by 4 to see what does that look like on an annual basis. Well, if I take the gaming revenue, 1.6 billion of quarterly revenue, and I annualize it, I get 6.3 billion dollars. That's down again from what they're supposed to report here next quarter of 8.8 billion. So what this means is that this current financial year is going to be a down year for the company because they already have 3 quarters of declining revenue, but then next year, because this number is still declining and has $3.6 billion in Q1, it's lifting up the current fiscal year. As time moves forward, next year is going to be a little bit lower than the current year because this 1.5 billion that they're currently booking on a quarterly basis, you'll have 4 quarters of this rather than having the 3.6 billion in Q1, which is basically the top of the market before this whole collapse happened. They had one great quarter, and it's been down from there, and that one quarter is lifting up the 2023 year. So I do expect 2024 year to be a little weaker than 2023. But these are the numbers I want to run with. So I'll take 16 billion for the data center, 6.3 billion for gaming, and I'm going to forecast that forward. A total of next year revenue of $27 billion for 2023. I'm going to apply a 25% EBITDA margin to that. That's down from the 43% they peaked at. 42% was the peak. If we look at this number, by the way, the EBITDA percentage, right? So the vast majority of this time frame, it's never been 42%. In fact, most of it's been around 30%, only spiking that 1 year, which makes me a little suspect about booking that much earnings. But nevertheless, 30% seems to be the target. So if 30% is the target, I'm going to start off with 25% EBITDA margin for next year because revenue's down, they haven't cut cost yet. As revenue resumes growth over time, and they kind of thin back margins, cost a bit, they can get that margin back up to 30%, my long-term target. So they're not going back to 42%. But here I'm saying $27 billion is next year's full year number, with 3/4 of that being actuals. I'm just estimating 1/4 of this year. $27 billion at 25% EBITDA margin means $6.7 billion of EBITDA. Now, the following year, I think it's down again 10%, $24 billion of top line revenue. Why? Because now gaming has a full 12 months of this lower performance that I don't think they're going to come rocking back. The laptop sales, HP, Dell computers, those companies are seeing softer demand for laptops and such processors inside those laptops. So I think they're going to come down. I think then they can resume growing, and the data center will pick up. The other business lines will grow as well, and they'll go to 30 and resume kind of a conservative growth rate, 25, 20. I'll bring it down over time to give me some kind of adjustment for the unknown in the future. And I think if you look back at the last video where we did not have a down 10% decline, had I forecast 10% decline a year ago, people would have thought I was nuts. The stock was untouchable for people. But now we're adjusting to reality. So now I've cut that stock forecast back, basically taking their growth rate and shifting it out a couple years so that in time they'll eventually get to what we said they were last year, but it's been shifted out a couple years. Let's see what that does to value. So then out a decade, I've got $70 billion of top line revenue and a 30% EBITDA margin. Gives me a $20 billion EBITDA forecast. If we look at what they produced last year, they produced $11 billion. So I'm saying they're going to double their profitability over the next year. So that's growth. That's saying you're going to grow in the future. The question is what multiple are going to sell at that time and what is a reasonable number for the business. All right, here we go. Let's forecast this business. So EBITDA, 6.7, 6.8 billion next year. That includes the decline of the gaming business. That's what our estimate is. And then the following year, it's going to decline again, 5.3, because you get the full year effect of the lower gaming revenue. Then by 2025, we should be seeing better results as the economy kind of picks up and you get growth, margin growth, revenue growth. You get a nice pop in earnings, $7 billion. And then it goes out to $20 billion, like we said. I'm applying an 18 times market multiple to this. This is still down from the 54 that it's currently at because I fundamentally don't like paying that much for stock. It's my money. I'm going to choose to buy things that I think are well priced. And for me, a stock I have to wait 50 years to get payback on is not a well-priced stock. Even if it's growing, like we just saw with the adjustment, you have no idea what this future is going to be. This is literally a guess. I just put up some numbers, put some logic to it, but still a blind guess. So if I'm putting money against a guess, why should I compound that risk by saying this number needs to be 50 times? I'm going to bring it down. 18 times 21 gives me a $378 billion enterprise value. Less debt plus cash give me $385 billion of market cap. Divide that by the 2.5 billion shares currently outstanding, and I get $152 as a stock price estimate for this stock out 10 years from now. If I do the same logic for free cash flow, here free cash flow, $2.21, that's my adjusted number, and I bring that down with the same growth curve I use for EBITDA, I get $6.86. I apply a market multiple to that, a market yield to that, a free cash flow yield of 4%. Again, we want things that are 6, 8, 10, but I'm giving a 4, and that gives me a stock price of $171 per share out 10 years on a free cash flow method. Before we review the actual stocks and the EBITDA, I want to let everyone know I have a webinar coming up. If you're interested in what a cash flow club looks like that I host and run, where I talk about one pages or what my picks are for 2023, I have a webinar coming up at the end of January. I'll be online. Our analysts at the Cash Flow Club will be online. We're going to review some of our top ideas for 2023. We're going to talk about the market. I'll give you a little bit more about my background, and we'll have an open dialogue with some question and answer sections at the end. Check my website or the link down below, cashflowinvestingpro.com, for the cash flow webinar at the end of January. So behind me is the updated data for NVIDIA. You've got a current price target of $165 a share. I can buy as much stock as I want. I've got two different price estimates, $171 and $152 based on two different methods of logic. I'm going to average that for $160 price target. Now, what do we know about the stock currently? Well, at the current stock price, the enterprise value of this business is $410 billion. That's $165 per share times the shares outstanding plus the debt minus the cash gives me $410 billion of value. If I divide that by next year's EBITDA, which is lower, that means I'm at a 60 times market multiple forward earnings on my number. If I look backwards and say what was the $11 billion of EBITDA they produced last year, divide by the current market price or enterprise value, I get a 36, 37 times market multiple. So the market multiple has come down on a historical basis from 55 to 36. But 36 is still much higher than I'm willing to pay for it based on our exit value of 18 times. So you're still going to have market multiple compression over time as this business growth stabilizes and people realize that maybe growth isn't going to grow at 20, 30% annually. That you're going to get 4, 5, 8% out of the company and the market multiple is going to fall. That falling of the market multiple is going to slow your stock price growth even though earnings are growing. And then I've got some yield here data, but I think the biggest point here is that it's 60 times forward earnings. So when I look out in the future, people are saying I'm still going to pay you a 60 years worth of earnings knowing that earnings are going to decline. Let's put this in an IRR and see what it gets. So I buy the stock for $165 a share. I had this stream of cash flow. I sell it for roughly the same at $160. And I get a 2% IRR or 1.2 times my money. I'll put this in a distribution for you so you can see it over time. If you fast forward or you come back to this video in the future, price target 165. This forecast 2% IRR. If the price increases, it's less. If it drops, I'm still not a fan of the stock unless it's sub 100. I mean, if you're buying it at 18 times, if you're selling this business at 18 times, let's see what 18 times forward earnings. I'll pick up a couple years out just to be fair. If we think earnings, EBITDA is going to be $7 million out year, and I go 18 times that, that's only $126 billion of enterprise value. Cash and debt are roughly equal, so that's also market cap. If I take this, divide by the shares outstanding, if I take this and divide by the shares, outstanding, I get a $50 stock price. So I think the downside potential for this stock could be $50. If it's $50, you're paying $160 for the share. Long term, we think it's roughly worth $160. So you're risking zero capital gain for a decline of almost 70%. For me, that risk reward isn't there. There's lots of other stocks that don't need the growth curve to produce outsized returns. So for us, let's review the 5 key factors. Number 1, top line revenue growth. It's there. Check the box. Number 2, EBITDA growth. Yeah, let's check the box. It's there. Number 3, strong free cash flow. Yes, absolutely. It produces a lot of cash. Number 4, low debt. Yeah, debt's 0, so it's low debt. Number 5, well priced. Is the stock well priced? No, I do not think it is. I still think this stock is way overpriced. Earnings are coming down. It's trading at 60 times forward lower earnings. The market is completely expecting this stock to revert higher, and I think that there could be a surprise to the downside if that doesn't happen. If this stock were to return to, say, a 18, 20 times multiple, that means your stock's worth $50, and I'm not willing to trade the little bit of cash flow that it generates on a per share basis for the potential loss of that kind of money. So what I'm going to do is I'm going to give it a bad rating. Not because of the company itself or the people or the products. I think all the products are legendary. The people are phenomenal. The CEO is an amazing guy. I just think the stock is too expensive, period. So for me at the channel, we're going to pass. We're going to look at other free cash flowing items. We're going to go buy those. Now, while I'm on the topic, I'm going to stop and tell you a little bit about the Cash Flow Club and what a one-pager is. Now, I produce a one-pager. What is a one-pager? It summarizes what I went through with you entirely in one page. You get 10 years of revenue and EBITDA, cash flow, debt, historical numbers. You get a 10-year forecast for EBITDA, for cash flow and EBITDA, market multiples, a write-up chart, and I summarize the 5 key attributes for you right there. What I do with these is I print them out for the companies that I've always wanted to own, and I lay them on the side of my table. And I pick them up every 6 months and I look at it. Because what happens if the stock market moves up and down, you might not have time to do all the research, but you can quickly gauge the business. Is it growing revenue, earnings, strong free cash flow, low debt? Is it well priced? No, but it could be well priced in the future. And having this on hand is worth a lot. I will also say that we kick out about 10 to 15 of these stocks every single month. And over time, as you look at these, you're going to build a wealth of knowledge, a perspective that's going to show you what the landscape of investing looks like. And you're going to be better armed to buy what you perceive as a good deal, having looked at lots and lots of companies over time. You'll be able to pick out truly the best companies that you want to put your money into. So I would highly recommend signing up for the Cash Flow Club. If you do so in January, I've got a webinar. You can see what the quarterly webinar looks like here at the end of the month. That's a $30 charge normally, but it comes free with the Cash Flow Club. We're going to be picking our 2023 stocks. Take a look at the Cash Flow Club. There are tremendous stocks in there that have IRRs a lot higher than this one. Also, if you want a free one-pager, click the link in the description below. I greatly appreciate that. Also, lastly, I do teach a course. If you're interested and you want to do the modeling yourself and have your own portfolio of stocks, you can do so. Take my course. Lots and lots of people taking it, and they really, really enjoy it. This is Rational Investing. I want to thank you again for watching on YouTube, listening on the podcast. Feel free to email me if you have any questions or comments, or throw a comment down below for the YouTube viewers. Help me with the algorithm. Throw a comment down below. Tell me what stock I should do next. I'm happy to take recommendations. If you read the comments in there, there's a lot of people posting some pretty amazing stocks that I really, really like. And I don't have time to get to all of them. I apologize. But I do see the comments. I do read them and try to respond as timely as I can. Again, I really appreciate it. Up is going to pop a couple other videos of discounted stocks that you might want to take a look at. Feel free to take a look at those videos. My name is Cameron Stewart, CFA. The Rational Investing is the show. Greatly appreciate it. Have a great day, and we'll see you next week. Bye-bye.